Welcome to Momentum Monday. Howard, how is your Apple position doing?
Well, you can't help but lose money on days like today. I think if you followed me a couple of weeks ago, we were selling some in the 220s, my long-term position. But, it's my biggest position, and down 10% is almost 15% is real. And I did buy a few shares today. Let's go right into it. I mean, the markets went. A lot of smart people are saying, "Oh, we went from an overvalued market in an uptrend to an overvalued market in a downtrend." I think you can see here Apple's being drawn to its 200-day moving average right around 190, 192. But you got 2 or 3 huge days of selling. Don't know what to say. This is what investing looks like when you're a long-term investor. 10 years this may look like noise, or this could be the beginning of the end for Apple. That's the way it always starts sell-offs, whether they're leading companies or not. And I'm bullish, so I've kind of written about it on my blog forever. Nothing really changes here.
It's not only Apple though this earnings season. I mean, if you take a look at all the FANGs in general, the market reaction this earnings season has been pretty poor.
Let's go through where we got Netflix also broken.
And it's just a reflection of the current market mood. I mean, yes, some of those stocks valuation is pretty high, and they can easily drop 50% in a real market correction. Mm-hmm. But there are stocks like Apple that you cannot really make the argument that they're expensive, really.
No, but it's still, it's only really back to the June, July run where it crossed $1 trillion. So it's given back the trillion. That's psychologically a big thing. But longer term psychology wise, we've now had companies trading above $1 trillion. And that may just be the time, just when Cisco kind of traded at $500 million or $500 billion, and then the market went into a, 10-year bear market. I guess the same thing could happen now that Apple's hit $1 trillion. I think the companies for their time are a lot different. Apple is the cash machine, and Cisco was half the companies they were doing business with in 1999 went out of business, or 3/4 of the companies they were doing billing, are out of business. And you can see Cisco here. You pull it up; it's a lot different chart as well. It's recovered. And in this sell-off, where we see it's held up pretty well, actually.
Yeah, compared to the rest of the markets.
Yeah. So listen, it feels like we could drop another 10, 20% on the indexes and, to drum up some fear, and everything will get hit. But there was some, if I were to look back at last week, yes, prices are high and things are not perfect out there, but there was some really good selling in a lot of leading names, including Amazon. And but I don't know if we take out. Listen, I am not excited about this market at this point. I think we've been clear about that the last month or two on this show. If we take out 160, if we take out those lows on Amazon, close below 1,500. I don't understand how you could not want to lighten up further in the market. If you were, and I've said this before, if you were scared last week, at the beginning of last week, and you weren't selling some by Friday when markets had rallied 5-6%, you just aren't doing it right. And if you want to entrench yourself here and be ready to survive a 10 or 20% more further bear market, you really got to know what you own, because you don't want to get shaken out. But I think, 260 on the S&P, and there was some good fear down there. And on the NASDAQ 160, I think we're in no man's land personally until I see more leadership, and that's where we'll go to you, Ivan. That's my thoughts. I don't really have anything.
Yeah, I mean, definitely, it's worrying that the major indices like the NASDAQ 100 and the S&P 500 are finding quickly resistance right below their 200-day moving average, but it's also expected that you see some buyers taking profits and short sellers renewing short position here. So the important thing is if we're going to make a lower high and then break above it and start leading more stocks breaking out.
Yeah, I'm not seeing much strength. I mean, unless, the Pepsi, if we were looking at what's strong, Pepsi, McDonald's, Starbucks.
Consumer staples, yeah.
Johnson and Johnson. The defensive stocks are doing well. It doesn't interest me. We own a couple of my 8 to 80. We own Johnson and Johnson and McDonald's, and they've held in. But again, I don't want to buy them when they're going up. They're not growth companies. They benefit from moves in the dollar, and they benefit from so many different things. So they're such diversified holding companies that I'm just not comfortable chasing them. And Verizon, here's Verizon broke out, but I mean, it's not going to get away from anybody, I don't think. And so if you got to put money to work, I guess, and you want momentum, Verizon looks good, but I deal with the company every day and I hate them every day. So I just don't know. Is Coca-Cola there breaking out?
Yes. I mean, all the consumer staples are breaking out. They're leading. And
what does it generally mean, Ivan, when they're breaking out?
Well, the market is extremely defensive and it's basically trying to discount a potential recession 6 months ahead.
Right, and eventually these give back. If we truly go into a recession, these stocks also hurt. So I don't know why people would chase them. It's just people don't want to. Sorry.
Eventually, they'll get hit during a real market sell-off when we see forced liquidation. Yeah. Those stocks will get hit as well.
Yeah, right now you see people doing the playbook and they're hiding out. They don't want to pull their money out of the market. So the big funds are putting their money into defensive names. And I love McDonald's. Obviously, we bought it in my model portfolio in the 150s, but I'm not going to add it here. And if the market goes to new highs, I mean, I do think McDonald's is a bit of a growth company in the sense that they've, cleaned up a lot of stores and added a lot of tech. So if it goes up, great. I love the company. Is it at all-time highs right now?
It's very close to all-time highs, and you can see a breakout today. And
can you go back further on the monthly?
The main reason probably is Kanye West's tweet this weekend when he said that McDonald's is his favorite restaurant.
I have to say, and I joke about this on the show, I'm there once a week. As a rider, I plot out where McDonald's are for either a black coffee or a breakfast burrito. I can't eat the fries and the burgers. I just can't. But I swear to God, from a black coffee to just getting water or napkins and spending money on a burrito for a couple bucks, I'm in there once a week. And I'm surprised at how clean a lot of them have become in the United States, even in bad parts of San Diego and Phoenix. And also the technologies. I don't love the robots and the technology, but people do. People use it. And McDonald's is it's just the stores are different. And so, I mean, that looks incredible. So does Starbucks. And I don't like the product at Starbucks, but I am not the market.
Starbucks broke out on your all-time price last week. And ever since that payroll report.
I gave up on the stock in the mid-50s and swapped. I got that wrong. I swapped it into McDonald's. So theoretically, that swap is like a wash, and I added Lulu in my model 50. So that in my model 8 to 80 portfolio. So it worked out. But like Starbucks, I wish I felt better about the coffee and the product itself. But they are a tech company, and in the sense that their debit, their payment, or their their app for loading money. They're almost like a bank for short-term cash. So congrats to the people that stayed with Starbucks. I think it proves again why I have an 8 to 80 portfolio. I just swapped it to McDonald's, but like these great companies that have a habit, that sell products that just are so widely distributed, when they're down 25% is you don't chase them when they're up here, but when they're down 25% are when you add them. And that's why you got to build lists, which is what we're doing now. So Starbucks, I mean, what's your head? Do you drink Starbucks, Ivan?
I don't, but I see my girlfriend constantly ordering on her app, and she said it's super convenient. You order on the app, you arrive at the store, everything is ready for you.
Amazing. So yeah, I've never done it, and I guess I'm at a disadvantage. Let's go back to the monthly. Yeah, I mean, unbelievable, incredible company. You know, it's kind of gone sideways since 2014. You have to be really patient.
I mean, maybe in some people's eyes, Starbucks is a stable company now, but it's not really.
You may not double your money here quickly, but you know, I think, and it's breaking out of a 3-4 year base. So congrats to those long. I'll stick with McDonald's. I can't own them all.
Only Starbucks. Ever since the payroll report last week, which finally showed some growth in wages, we saw quite a few restaurants and retailers outperforming the market, better in the market. I mean, we're seeing even companies like Pollo Loco and CMG. It's not just McDonald's. Just doing better than the market. Or companies like Alta setting up near 52-week highs. Look at that base that they're building. And of course, if the market has another quick lower, this setup will fail. But these are the current market leaders: consumer staples and then some retailers.
Yeah. All right, you want to go to yeah, wow. So let's go to your list, Ivan. See what do you got?
This is the list. I mean, Tesco Tractor Supply Company looks interesting. It's technically Ulta, Starbucks. You see a lot of retailers, and then you have this is really interesting company, XLNX. They crushed my estimates, and they showed relative strength like last week.
Oh, that's a chip stock, so Xilinx. Okay.
They had
let's go to the weekly and monthly. Wow.
This is the weekly.
Okay. I'd have to do some work on that one. See, I mean, that is a mass. I mean, that's in a sector that's been getting hammered.
Exactly. I mean, if you compare it to the SMH, it's doing amazing, right?
Okay, so when did that get added to the list, Ivan?
Let's see. So this is its second week, so last Monday.
Okay, so there's a lot of new stocks. It's really what you want to see. CME Group also done well. I was in the NASDAQ, which kind of got beat up, but it's now coming back. But so you've got a lot of new companies. Zebra's been in there a while, which is a great company. E-commerce.
Yeah, Twitter is back.
Yeah, I don't like Twitter compared to like the market and everything else, and just poor management. But they have at least regained some amount of respect from Wall Street with that last earnings report.
Yeah. Most of the ex-Momentum darlings.
They're all down like 20-30%.
In the tech universe, look at them. They're all red today. Look at it. Twilo.
No, but look at their moves from the highs are really bad.
Well, this is what happened to momentum stocks in market corrections. Like people short them.
Yeah. No. Well, Mongo's held in there well.
Yeah.
Yeah. I'm not looking for new stuff right now. I'm really waiting for just a little more strength. With Apple really taking a bludgeoning, I think people, are going to have to see a lot more strength. And then just this week, I don't need to bet on tomorrow's election. So I think it's a quiet week. Hit us up if you have questions. Ivan, thanks for doing this. Thanks to Market Smith for your charts. But where are you at, Ivan, with positions? Are you really light right now?
Right now, I'm in cash.
All right, so Ivan's in cash. He's been right for a while. If we're wrong and Verizon and Starbucks and McDonald's continue to lead, you're not missing out on too much in terms of I don't think in gains, and we'll revisit it next week. But I think with Apple and the Nasdaq under selling pressure, we're going to have to see some true growth. And keep an eye on the wages, which is good, but could lead to inflation as well. There's that little
wages are a lagging indicator, so you're right.
They're a lagging indicator. I mean, the big, hairy, ugly thing is something that just we've gotten used to ignoring because of technology is inflation, and it's quite possible, out there, and the market just would hate that. So again, I think risk to the downsides just a little too much more than playing to the upside, and so unless you have an edge here, I'd keep it light. And I'm going to let you go, Ivan, and talk to you next week.
Yes.